Hey guys, it's Daniel again from the S&G Bookkeeping channel, and today we got another tutorial for you guys. So, as an e-commerce business owner, let's say you just took out a loan. Well, on that loan, you're going to be paying the loan and interest back, and it's important that you keep track of that interest so you know exactly how much expenses you have in your business. And you have to do that in QuickBooks Online. So, before we get into that, just a quick reminder that we are still offering our free 2-hour complete personalized walkthrough where we go over anything your business is struggling with and explain it to the best of our abilities. Now, Arthur's going to walk us through interest tracking in QuickBooks Online.
Whenever you take out a loan for your business, you're typically not only paying for that loan, you also have to pay interest on that loan as well. And that's something that you should be tracking inside of QuickBooks Online to give you the most accurate idea of exactly what expenses your business is taking on. So let's do that inside of the sample company with Craig. However, I want to pull up some numbers for you to help put this into perspective. So let's say you take out a $6,000 business loan for 1 year, and in this case, you're paying 5% interest. So you'd have to pay $300 at the end of the year for the interest that you incurred as a result of this loan. So the way that interest technically works is that it accrues on a day by day basis. So every single day that after you take out the business loan, your interest expense would actually go up. Meaning, every day, if we divide this by 365, we'll see that every day you're technically liable for 82 cents, but it's not realistic to enter that into QuickBooks Online every single day. So what most people do, what most companies do, is they add an adjusting journal entry every month, maybe every quarter, or even every year to take into account the interest expense that they took on for the period. So let's just remember that 300 that we typed in, and we could actually track that by going up here to this top left and then press plus new and journal entry. Now, once that loads, we have this screen right here. And the first account we want to add is actually that interest expense account for that $300. And we actually don't have that inside of QuickBooks Online. So let's add a new one. And scroll down to, it'll be an expense. Scroll down to interest paid. And let's just call it interest expense. You don't need to really add a description or a sub account. So let's just save and close. And then the other part, let's say in this example, we have that $300 expense, but we haven't paid it yet. So because we took on that expense and it's our duty to pay that, it's actually called a liability for us because at the end of the day, it's still our responsibility. So in this case, it's actually called interest payable, meaning we have to pay it sometime in the future. So we also don't have that account, so let's add new. And there's no specific interest payable account, so we'll just call it an other current liability because, as I mentioned, this is a 1 year loan. So anything 1 year or less is a current liability. Same thing with assets. So if an asset can be turned into cash within 1 year, that's also a current asset, but that's not the main point of this video. If it was longer than 1 year, we can call it a long-term liability. But in this case, let's call it other current liability. And I don't know why it's deferred revenue. Let's scroll down other current liabilities. There we go. Interest payable. We don't have to worry about this information. So let's save and close. Now, remember that $300 that we calculated? Anytime you increase an expense account, which interest expense is, you actually debit it. So anytime you debit, you increase an expense account. And debits always have to equal credit. So in this case, if interest expense is 300, that must mean that our interest payable has a credit of 300, which also makes sense because anytime you increase a liability account, which interest payable is in this case, you also have to credit it. So now that we have 300 on both sides, we can see that they equal out and we can save and new. Now, if we exit out, I just wanted to show you how this actually affects our financial statements. So that interest expense, if we go to the left and click on reports, that interest expense will show up on our profit and loss because the profit and loss lists all of your expenses on there. So if we scroll down to the expenses section, there it is. We can scroll down to interest expense right there, $300 that we just entered. But now if we go back to report list, that interest payable that we entered as well, since that is a liability, it shows up on the balance sheet because the balance sheet shows your assets, liabilities, and your owner's equity accounts as well. So if we scroll down to liabilities, there it is. We put it under current liabilities, so it should be here. Other current liabilities. So there it is, that interest payable for $300, which is the same as the interest expense account that we entered on the profit and loss. So I hope this helps you get a better understanding of how you can actually make these changes to your financial statements to give you a better idea of where your business stands. So thank you so much for watching.